Hi, everybody. So this is another one of the Mentalist Entrepreneur Circle, showcasing an opportunity to talk with one of the businesses that I've used repeatedly. We think are incredibly clever. They can do some really great stuff for members. So it's corporate finance, but I know Andy and Lee for a while now, and they've actually helped me raise some money in very innovative and creative ways. It's not just a straight line raising money anymore, and how you can use that money and put it to best use in your business. So, so yes, and our relationship with Moorfield goes back about 10 years. So a very trusted supplier. Which one of you two lovely gentlemen want to kick off today?
I'm happy to kick off. Thank you, Gary.
Brilliant. Andy Pear, Gary Goldsmith, out.
Thank you. Morning all, my name's Andy Pear. My colleague Lee Coutange is on the phone with me, on the call with me today. We really wanted to talk about creative funding solutions for your business. And just taking a step back and think about why we need to use funding in a business. It's all about growth, really, growing the business as quickly and efficiently as you can, hopefully towards an exit in the future at some stage. So really, you're looking at raising finance to really accelerate that growth process. There are a huge number of options out there, from debt capital to equity, and it can be a minefield if you really don't know what you're looking for and how to structure it. So in the session today, myself and my colleague Lee wanted to explore the different types of business finance, how to approach the market, pitfalls to avoid, personal guarantees, things like that, and when to rely on an expert such as Lee in terms of raising debt for your business. So on that note, I'll hand over to Lee to talk about debt finance.
Thanks, Andy. So here, hi everyone, I'm Lee, Director of Moorfield's Commercial Finance. So I guess starting off talking about a few options within the debt space. So traditional funding facilities such as your bank overdrafts, your term loans, export and supply chain funding, so trade finance as an example, which obviously helps in the purchase of goods from abroad when payments have to be made up front. You've got obviously in the recruitment space, payroll and contractor funding. We've got the government growth scheme, which obviously is very prevalent at the moment in terms of a government-backed offering for lenders. We've got revolving credit facilities, which are been around a long time, but fairly unknown in the market. And they seem to be becoming more and more popular, along with invoice discounting, factoring, which encompasses single invoice finance as well. So those are the main elements of debt capital funding that we would like to talk about today.
That's brilliant. I don't really understand revolving finance, revolving credit, so that's interesting.
Do you want me to give a brief overview?
Well, do you want to just do a couple of lines on each one, just so that everyone's just aware of everything that you've done?
Yeah, so invoice discounting and factoring. So you've got confidential invoice discounting, which is whereby invoices are funded. So using recruitment as an example, you can get 90% to 95% of your invoice funded. So if you've got an invoice of £100,000, you get 90 to 95,000 made available to you, which helps with your working capital cycle in payment of wages. Revolving credit facilities basically is a facility which is put in place whereby you have an amount made available to you. So that amount could be £200,000, depending on what the business needs, and that's repayable over 90 or 120 days. So once the debt's been once the funding's been repaid, you can draw it again. So it continues to revolve, but it's not against the debtor book. It's just against the financial performance of the business, effectively. So it's kind of a revolving loan, for want of a better way of putting it.
Would you require to put a PG against something like that?
Lenders normally want some sort of tangible security there. So yeah, so it could be a personal guarantee, or if there's a property in the business, it could be secured against that. But it's on a case by case basis, Gary, really. So yeah. In most instances, yes, but in some cases, no, depending on the strength of the business.
Okay, cool.
Government growth scheme. So that basically is a pot of money that was put forward by the government, whereby lenders are guaranteed 70% of the loan, with a maximum turnover for businesses of 45 million. So if your turnover is less than 45 million, you qualify for it. And it is basically an alternative loan, and also can be used in the invoice finance space whereby if you've got a transaction you're looking to go through, you can bolt the government guarantee scheme through some lenders as well to give a cash flow loan on top. And it also can be used to increase the prepayment with a couple of lenders. So, for example, if you had a prepayment of 90%, that could be increased to 95% by using the GGS, and it's backed off to the government effectively. Which again is a really popular method of funding at the moment, especially in invoice finance for management buyouts, management buy-ins. We've seen it used a lot.
Is it cheap?
Is it cheap? It's all relative, I suppose. I had a recent example which was 15% on a 350k loan. So it's not massively cheap, but
No.
it's still cheaper than your funding circles, your iWalkers, those kind of lenders. And
Okay.
again, it's all on a case by case basis based on the business performance.
Brilliant.
We've also got obviously payroll and contractor funding, so that's more in the recruitment space, whereby you can have a back office function that covers payroll. You've got single invoice finance, which again kind of does what it says on the tin. So instead of having your full debtor book funded, you can just pick and choose invoices that you need funding against. So you could use it, once a year, twice a year, 3 times a year, 4 times a year, depending on if you've got a seasonal business, for example. We've got clients that use single invoice finance, and what we've found is that when they start using it once, they tend to use it more and more regularly, which then makes it more expensive. So when it gets to that point, we tend to move people across to a full invoice finance facility, just on a cost base, for a cost saving basis. You've got your tradition.
So the single invoice piece, if it's a big number, what's the lead time to actually get authority to put something like that through?
Normally it happens really quickly. The only thing that a lot of the single invoice finance providers want is the debtor to confirm that they're happy with the invoice and it's going to be paid. So if you're dealing with a local authority, for example, it takes a bit longer because you've got to get to speak to the right person. Whereas if it's a normal sort of generic business with an accounts payable department, it tends to happen more quickly. So I've seen them turn around in 24, 48 hours, but also it can take up to, say, 3 to 5 days, depending on if they can get hold of the people to verify the invoice.
Okay.
Yeah, the single invoice finance market has really evolved over the last 5 years, hasn't it, Lee? I mean, we've seen some new entrants come into the market, and they're fairly creative in what they can do. They look at funding export invoices and help companies penetrate new markets. So there's some really interesting players out there now.
Yeah, it's a good point, Andy. So another area we've seen single invoice finance being used is, for example, if you've got a business that does a lot of export, some of the mainstream lenders don't like funding export, so they'll put a restriction on the amount of funding they get, and some of the single invoice finance providers will tag along the side, share security, and they'll fund just the export piece.
Okay.
So again, it's just food for thought.
And I'm guessing any currency, nothing's an issue.
The only issue at the moment is Middle East.
No problem. Yeah, get
which
that.
as I'm sure you'll know, and that's a historical thing, really, not just with what's going on at the moment. It's just the legalities of funding invoices or providing funding to the Middle East is very, very difficult. But we're hoping that one day someone will come up with it, and we'll all be very, very happy. Overdrafts is the next one. So obviously a very traditional form of funding. But what we are seeing is the banks don't like issuing overdrafts, purely because what tends to happen is, obviously with an overdraft, you tend to use your overdraft, come out of the overdraft, go back into the overdraft, and the bank don't see it as the best use of their money. So they will try and move things onto more creative functions such as invoice finance or a revolving credit facility, because it's better use of their money effectively. I'm not seeing many overdrafts being done at the moment, if I'm honest. Banks don't seem to have the appetite to do so. If they do, they want tangible security to support.
Right.
You've got the traditional term loan. So again, we've got unsecured loans, which I think difficult market for unsecured loans at the moment. I think a lot of lenders are tightening up the criteria and lending appetite, but they are available, but they're not the cheapest in the world at the moment. So we can look at stuff from anything from 6 months upwards. I've had a couple approved recently at 2 years, and again, like I said earlier, GGS at 5 years. So they're still out there, but are just a bit more difficult to get hold of at the moment.
Okay.
And lastly, export and supply chain funding. So obviously touch briefly on export within single invoice finance, but obviously there are lenders that will fund 100% export, and also the supply chain side of things, so trade finance, funding goods to get on the water. And also, I suppose you can include an element of stock in there as well. Stock finance isn't really readily available, but you can tie in a bit of trade finance to that, whereby they're not too worried about whether they're funding a little bit of stock in there as well at the same time. They just want to know it's for a confirmed order, effectively. So
Yeah.
those are the main facilities that we're sort of seeing being utilised at the moment.
Thanks, Lee. Do you find directors are often reluctant to talk about debt or take on debt? Because, you know, if I've started an SME business, you kick off with putting a bit of cash in, don't you, as equity to get the business off the ground. Do you think directors are sometimes view debt as a negative thing to explore, or do you?
Yeah, I
Was
think.
that
Sorry,
to
Gareth.
me or to Lee?
Believe and
Yeah.
you, Gareth.
Okay. Good, Lee.
So yeah, I think so. I think it's also hard, if you're trying to get your business to the next stage. I think it's always a challenging conversation in terms of what is the best product. And I think the other issue we've got at the moment, or the issue we're seeing, is people are going on the internet and typing in, what they want, and 9 times out of 10 getting an unsecured loan, which is sometimes a sticking plaster for a larger need. So what we tend to do is take the time to understand, what the business does, how it does it, where it's going, what the aspirations are, and then basically partner in the right funding facility. So yeah, to answer your question, Andy, I think there is some sort of resilience there, or there is some sort of like cautiousness about taking on debt, but it's just understanding what the business is doing and where it's going to make sure that the right form of debt is secured, and not taking the wrong debt and then causing issues or headaches sort of fairly short term.
Yeah, I mean, you want debt to be used for growth, really, don't you? I would imagine you want to grow the business. You use debt to fund that growth,
Yeah.
but effectively you're bringing on another stakeholder into your business, aren't you? And you're having to show them your accounts, show them your forecasts,
Yeah.
sign a personal guarantee in some situations, which
Yeah.
nobody likes giving a personal guarantee, do they?
No, but again, it's understanding what the personal guarantee is, why it's there, and also understanding what level of personal guarantee someone wants. So if you're looking at invoice discounting and factoring, for example, it would be normally a limited personal guarantee to a percentage of the funding line. Whereas in the unsecured world, looking at a short-term loan, 9 times out of 10, the lender would want a full pound for pound personal guarantee.
That's a good point. We see a lot of directors who sign up to funding lines with iWalker, Funding Circle, with unlimited personal guarantees. And I think that's crazy, isn't it?
Yeah, that's the unsecured world. They've got nothing to take a charge over. Whereas at least with invoice finance, for example, you've got the debenture there, which obviously covers certain assets within the business. Or if you're doing a secured loan, you've got property there in the background to hang your hat on. Whereas in the unsecured world, it is exactly that. It's completely unsecured.
Yeah.
Can I just ask a couple of questions on that? So, to answer your question, Andy, I know a lot of businesses who wouldn't take on debts unless they knew that they had 3 months' money for operating costs just sat in the bank, and then they'd use that to say we're safe for 3 months, and then they take debt on top of that to expedite some more aggressive growth. But they wouldn't want to go into sort of negative numbers because the world is flaky right now, and you never know how long you might have to hold your breath if something again were to go wrong, and you don't know with Donald what he's going to do next. So there's a slight reticence there. But taking on debts to affect an MBO, I mean, that's rife at the moment. I've seen so many MBOs happening. So to do an MBO right now, which is the easiest and best way for a business to look to fund their next generation. So I, as a leader, could leave. Where would you suggest people look?
Lee,
So, I mean, what we're seeing most at the moment is invoice finance, and some sort of cash flow piece on top if needed. That is probably the biggest form of MBO tool we're seeing being used at the moment, or that and a mixture of term debt, but with the same lender. and maybe even an ABL product, depending on what's on the balance sheet of the business. So, it's effectively looking to leverage all the assets within the business before looking at external debt, because obviously you want to utilize what the business has before going outside of that.
Yeah, I wish people had extra room in wiggle room in terms of debtor days and invoice discounting, because I think most people have just loaded that right up at the moment, and you can see why. So, yeah, really interesting. Thank you for explaining all those.
Yeah,
Pleasure.
I think on the personal guarantee point, I think personal guarantees we know can be a thorny issue, and I think it's about how you can limit or put a cap on the level of guarantee you have to give. And often lenders say, well, I want a supported personal guarantee. When they say supported, what they really mean is they want to charge on your house, which nobody wants to give. So are there any tools, Lee, that we can use to help directors limit their exposure under the personal guarantee? Or you put a cap on it and not have to give a charge on the house?
Yeah. So in again, going back to invoice finance as probably a prime example, it is a completely unsecured personal guarantee in I'd say 8 cases out of 10. So what that means is that the lender wants a personal guarantee from the director. So in the event that an event happens in the business, i.e. the business fails, they want the director to hang around and help them collect their money in. So if you've got so just for ease, £100,000 funding line, and they want to take a 10% guarantee, 10 grand, so that the director's liable for £10,000 effectively. All been well, money's collected in, and that's fine. That's there. But in the unsecured world, i.e., you're going to get a loan and you're borrowing 100 grand, and they want a pound for pound personal guarantee, they may ask for a charge over property. But if you don't own a property, then it is completely unsecured, and you are on the hook for that. So I would say with anything, it's about seeking independent legal advice, which I'd recommend when looking at personal guarantees. Asking lenders or discussing and negotiating with lenders if the guarantees can be capped to an amount where directors are happy. I mean, no one wants to sign a guarantee at the end of the day, but I think it's a massive reality now that most people will have to. And I guess it's asking why the guarantee is required. So speaking to the lender and understanding why. We have done facilities in the past without personal guarantees, but they are for sort of strong, strong performing businesses, robust debtors. So an established business whereby the lender can get comfortable that, the business is doing well, and it would take something out of the ordinary to knock it over. And also you do have personal guarantee insurance, which you could look at. But again, I've not used this myself, but I know it's out there.
You'd make sure, yeah, you'd want to make sure that insurance would ever pay out. Because if the debt were to fail, 9 times out of 10, you've got to assume then that the insurance would find a reason not to pay you. But
I also think it's, if you do get into that position in business, it's about being clear and transparent with the lender and
100%, yeah,
and being on board. The worst thing you can do is, it's very easy, and I'm sure, put your head in the sand, think it's going to blow over. It's best just to front it up with the lender, talk to them about it, what's gone on, help them with it, help them with the process, stay involved. Because at the end of the day, it's your business, they're lending money to it, and they want to get their money out. So, to limit your liability as much as you can, just help with that process.
Yeah, totally agree.
And what about the effect of debt, Lee, on an exit? If you get to the stage in your business life cycle where you're looking at an exit route, a lot of businesses, depending on the sector, are valued based upon a multiple of EBITDA. So in certain sectors, the multiple typically could be between 5 and 10 times EBITDA. So you get an offer for the business on a multiple of EBITDA, but that offer is often on a debt-free, cash-free basis, isn't it? So the value of the business based upon the multiple, but then before they get to the eventual enterprise value of the business, they will take off any debt on the balance sheet, won't they? So the more debt you're carrying on the balance sheet, the bigger the effect is going to have on your eventual valuation.
Yeah, yeah, exactly right. So you know I suppose it's one of those where you've got to be careful about the debt that you take out and what it's there for. I mean, it's very, people want to lend money left, right, and centre. It's just understanding what the business needs and is that the suitable product? Because as you've rightly said, Andy, you don't want it to affect the value of the business moving forwards, but at the same time, you might need debt to get it to the point where it can be sold. So it is just a fine line of deciding which function to use, and also if you are speaking to an advisor about debt, it's worth mentioning at that point that if you are looking at a sale or what the ultimate exit is, so that can be considered at a time where recommendations are being made.
Yeah, so it sounds obvious, but it's making sure the debt is structured in the right way on the balance sheet. It's making sure it's affordable. As Gary said, it's having that 3 months of cash flow in the bank in case you hit hard times. And then thinking about that, the impact that having another stakeholder could have on the business. You might be set financial covenants, for example, by the lender.
Yeah, and I think that is, and that's a key point about financial covenants. We do see it. We do see them being set. Not in all cases, but like you've said, it's about that being realistic and achievable. If you don't think it is, then challenge it, because the last thing you want to be doing is providing your monthly reporting, breaching a covenant, and then there's a more difficult conversation to be had. Whereas if it's not realistic from the outset, challenge it, because it's got to be.
In simple terms, Lee, I mean, what is a covenant? In this scenario, what is a covenant?
So a covenant would be monitoring the financial performance of the business. So it could be a net worth covenant or a profit covenant to what the financial or what the finance house would want to be achieved on a monthly or quarterly or 6 monthly basis. So if you look at, if you've got a net worth sort of covenant there, but you're looking to take some money out, or they might ask for a waiver or, an agreement whereby you can't take funds out without speaking to the lender first. But again, it's just understanding what the covenants are and if they are feasible, and explaining what the plan is over, if you are planning to do something like that, then just explain it. You should be able to take your money out, but they'd obviously want to know about it to make sure it's not at the detriment of the business.
Well, we had this when we took some money off the table. So our business was doing well and we hedged. So we took some money in from Barclays Finance, and the business was doing really well. We took 50 million quid for 20% of the company, and that was all off the table money. But in response to that, they wanted a golden share. So that golden share controlled everything. So we had to have a remuneration panel, which they sat on. There had to be, in terms of retaining profits, who got paid first, all of those things that they put governance on. And that made a difference to us. I would say if any business is thinking about putting debt into their organisation, you mentioned structure here and how it's all put together, and having an adequate financial dashboard so that people can see what's going on. 100% that's the time to have some sort of fractional CFO in the business. If you haven't got somebody there who's doing the job full time, make sure you get someone who's big enough, ugly enough, and grown up enough to be able to do these things for you, and meet with them for a main board once every quarter. So it's don't try and make it up yourself, would be my advice on these, because it's if this works for you, you'll probably want to go back to the well again and borrow some more money. But if you've messed it up first time, there won't be anything left for you.
I agree with that, Gary. I think that's a very valid point. Yeah, if you don't know the numbers, get someone that does.
Yeah.
It's as simple as that, really. Because again, it's all lenders will ask for a pack of information before proposing a facility, and you want that to look as good as it can do. There'll always be challenges around it, but if it looks a complete nightmare mess, the feedback you're going to get isn't going to be as good. Whereas if you've gone into it, it's as good as it can be. It puts you in a stronger position to get funding.
That's a brilliant example of this. If it's going to take you 2 weeks to come up and fill out all the data requests because you're looking for numbers for the first time ever, you're probably not best equipped to actually manage the level of debt that you're taking on. So if you haven't got somebody who can do that for you, and you've got all that at your fingertips, be very nervous about taking on something like this. You've got to be number literate to be able to do it, or
And
somebody
also,
has. You're right.
well, I guess the other point is make sure that if you've got other facilities in place, make sure you're open and honest about it, because lenders will go through your bank statements and they will spot these things. And again, it's a trust thing whereby if you've not disclosed something at the outset and you see it through the bank statements, it just, it can cause issues going forward. So just be open and honest about what you're looking for and what you've got on the table already.
Yeah, perfect. Did you touch on all four of these, or did we just? So if you get some cash in, this about governance in terms of, do you have to repay this money first if you're considering an exit? Was that what this slide was about?
Yeah, I think well, it's in terms of placing debt on the balance sheet. Yeah, it's going to impact your exit when you get to an exit, but B, the journey in getting there, you're probably going to have to navigate some covenants at some stage, and it's ensuring you understand those covenants and you can manage the business accordingly.
Yeah.
I mean, should we move on to equity capital, Lee? And we talked about debt for a minute, which is one form of finance, but equity is the other form of finance and possibly less well understood, I guess, in the marketplace.
Yeah. So we've got obviously a couple of partners that we work alongside for equity capital effectively. So we've got Dowgate, and we've got family offices for large capital raises that we use. And between Andy and I, we've got a big database of private capital investors. So I don't know if you want to touch on that, Andy. They're probably more your relationships than mine.
Absolutely. I mean, equity, you're generally bringing someone into the share structure of the business. So bringing equity in will involve some level of dilution. So in that respect, it's not to be taken lightly because you're giving away a part of your business. So why would you do that? I suppose you might do it if there's a JV partner that can bring something more than just cash to the table. It could be someone in a further upstream or downstream within your business, within your sector. Could be someone that could bring a huge amount of knowledge and experience to the business. But equity is perhaps less understood for that reason, probably harder to structure. And whatever you do, if you're going to bring in an equity investor, you most certainly want to have a shareholders agreement. That is absolutely critical to avoid any dispute or falling out or argument down the line. And then it's how you price that equity. It generally involves a valuation of the business before you bring in an investor, working out what each party brings to the table within that capital structure, and agreeing between you what the proposed exit route is. Is the investor coming on board for the whole journey, or they're just coming on board for a couple of years to see you through a certain period of growth, whereby they then step out to be like private equity, and another private equity investor comes in for the next part of the journey. So,
and is sorry to cut across. Is it worth explaining? So it's almost like Dragon's Den, or you might have somebody who's a small scale investor who will throw you some money for a percentage, and if you pay it back quickly enough, and you might have 3 or 4 clicks on that, then they just give you some of your shares back, or they sell some of your shares back, and you just take 10% off into the sunset. So versus somebody who's in it for the long term, like one of the bigger players, as we did with Barclays. So they were there for about 10 years, and till we took it to an IPO. So there are different ways to structure that deal, but the shareholders that we had, the shareholders agreement, oh my God, with every eventuality that could possibly happen, because we didn't want anything to happen and everyone to fall out somewhere down the line. And they're expensive to do, but worth every penny by doing it up front. So anything you do like that in terms of the next equity play, you're 100% right. It's got to be, just think about everything and anything that could possibly happen.
Absolutely. I mean, if you're going to have a shareholders agreement, I would recommend going to a good solicitor to produce it rather than download something from ChatGPT. And I suppose it's a bit like a prenup, isn't it?
Well, you
Yeah.
should be asking me. Thanks for that. Yeah, brilliant. That's 3 marriages before. Yeah, learned that lesson. Yes.
So equity, it can be challenging. There's not a ready market out there for equity investment. Generally, we would go to a number of different sources, whether it's a family office, a debt fund, or a stockbroker, to raise equity investment. Most stockbrokers, they have a database of investors, but they tend to back management teams, and they want the business to be profitable rather than pre-revenue or pre-profit or pre-break even. So that's one option. Another option is family offices, and then you've got crowdfunding. You know, the crowdfunding market has matured enormously over the last 10 years. There are a number of operators like Cedars, Crowdcube. Cedars is now branded as Republic. It's gone global, but these are ways to raise equity funding quite quickly. Perhaps more suited to B2C businesses than B2B, I would say. But with a crowdfunding process, what you might end up with is raising 250k or 500k and have an extra 200 or 300 individual shareholders on your capital table, all managed by one nominee, which would be the crowdfunding enterprise.
Is it worth also just mentioning? So if you do that crowdfunding route, or you go into a family office, they don't really want to be massively involved.
No.
Typically, all they're doing is they're looking at getting a return on their investment. That's all they're really interested in. Whereas some pure play investors in certain markets will be much more interested in fiddling, thinking, how does this fit in my bigger jigsaw puzzle? And that's when they might be putting you under pressure to change your name, to morph within the business, to lose control of your back office. So it's it becomes you either, if you do it when you're very big, that's great. If you do it when you're very small, that's great. It's that mid-market where you just got to be mindful of, I think.
Absolutely. I mean, crowdfunding, I would probably describe it as hands-off investment. It's generally patient capital. They're happy to sit back and wait. There isn't much pressure on seeking an exit. These are passive investors. But a good example, I suppose, is all the private individuals who invested in the crowdfunding for Revolut many years ago. They've become millionaires overnight. So that's crowdfunding at its best, I suppose.
Great business. Yeah. Cool.
Very good. We've covered shareholders agreements, we've covered covenants, we've covered personal guarantees. Lee, do you want to just cover off the pros and cons of sort of debt versus equity, just to sum up that bit?
Yeah, sure. So looking at debt, so the pros of debt is retaining control of the business and ultimately ownership of the business. Interest usually tax deductible. The costs are predictable, so you know what it's going to cost, and it's suitable for cash generative businesses. So the cons, sorry, are it can strain cash flow if not structured correctly. Again, just going back to financial covenants, so need to be suitable and make sure that they're fair and transparent, and also personal guarantees may be required. In terms of equity, pros being no repayment obligations, strength of balance sheet, access to expertise, and supporting growth, with the cons being dilution of ownership and control, slower decision making potentially, and more complex governance just because the type of product it is. So I think that gives a nice sort of weighted overview between the two products effectively.
I think that's brilliant. Yeah, very good.
Okay. Should we touched upon single invoice finance earlier, Lee, didn't we? I think we've got a particular case study we wanted to talk about.
Yeah, so we had, I think it's on the next slide. If we shift down. So yeah, so this was an example that was completed by a single invoice finance provider, and in a sector that isn't that well liked by invoice finance, if I'm being completely honest, renewable energy. So it looks like there's a 15 company in the group, positioned across UK, Europe, Europe, USA, and Asia. So again, going back to the export piece we discussed earlier, the business is expecting growth across multiple international locations. So they provided a non-recourse, which includes bad debt protection of 5.5 million, delivering 1 million to its international subsidiaries in less than a week. So the benefits to the facility were that the UK and European businesses were funded by an existing senior receivables and WIP facility of circa 24.5 million, and it can work seamlessly alongside existing lenders. So in essence, this was a tag on to an existing facility to fund the export markets, which is what we alluded to earlier. So this has allowed the business to further expand into new markets, less reliant on existing facilities to fund overseas growth. So we kind of thought this was a good case study, just tagging into what we discussed previously around the export space. And it looks like a really good solution, to be fair. So something to keep in mind.
Thank you.
Brilliant.
And yeah, the last slide is why Moorfields Commercial Finance. Hopefully, we've sort of shown our experience in various funding products, and we do take an independent, professional stance to a business's needs. So we don't go to who pays us the largest commissions. It is basically based on what is the best fit for the business, and we're also happy to offer a free funding consultation offer to any members, whereby we'll have a chat, see what the business is trying to achieve, and try and recommend some funding solutions for you.
Yeah, I mean, on that last point, Lee, that presumably includes looking at any existing borrowing facilities to work out if they're still priced at the best price in the market and still structured in the right way.
Yeah, so existing or new facilities, we'd recommend reviewing facilities at least once a year anyway, just to make sure that the facility is fit for purpose. There can be things changing in there all the time, so customer concentrations, prepayment, obviously your exports again, just to make sure that the funding the business has is suitable and still fit for purpose.
There's just something to consider. So there's a couple of people, Adam Buck, for example, and Darren Rymill, both put some massive debt into their business so that they could actually affect a change of their lifestyle. So they did partial exits of their businesses, bought new houses, changed their life, and they just put the debt straight back into the business because the business could afford it, but they couldn't take the cash out otherwise. Doing things like that, is there anything just to be mindful of? So if a boss wants to get a new house right now, or there's something changing within their life, is there a top couple of tips that they should consider before embarking on this? Because I'm guessing once you start one of these processes, the further and deeper you get into it, then it starts costing you money. You got lawyers' fees, etc. What couple of tips might you add suggest to people if they wanted to take some cash out of their company?
Seek advice would be my top one, to make sure that what they want to do is feasible and it's not going to have any sort of implications to the business later down the line.
Right.
Yeah, there might be different ways to take that cash out, not necessarily by leveraging the balance sheets, which is one option, but you might be able to, for example, borrow against the shares instead, borrow against the share capital.
We all did that at S3 until we had a margin call, but apart from that, it was brilliant. Yeah.
Yeah, I guess it just depends on what the person's looking to do and what the business looks like at that time, Gary. To be honest, it's just a conversation on a case by case basis, and then we can obviously look at what is the best fit for that business or the business owner.
Fab. Is there anything else that you wanted to add before we just do a wrap up?
I think tax advice as well, Gary. Really, the situation you just described in borrowing money against the company's balance sheet, so the owners and founders could take some cash off the table. It's often worth taking some tax advice around that as well. as to how to get that money out of the company as efficiently as possible.
Yeah, 100%. Great advice. We've got you. You're part of the circle. If people want to get in touch, any questions, anything that they're considering at the moment, or to do this finance health check, and you're willing to talk to them to do something for them right now, just see how they how things are laid out currently and where their opportunities are, I guess.
Yeah. So my email address is on the bottom of the or the last slide, if you like. So lee.catorch@moorfieldcf.com, or feel free to give me a call on my number, which is 07907 981 105.
Brilliant. Do you know, I actually, that was really cool. I'm so pleased that you did that, and I'm so pleased that you aimed at exactly that level. It's perfect for us. So massive thanks for you doing that. And I'm surprised that I'm surprised. Of course, it was going to be brilliant. So look, thank you very much for giving up your time, and we're going to share this with all the members as soon as possible. Right,
Thanks,
Andy,
Gary.
Lee, Emma,
Take care.
thank you ever so much. It's been really good.
Thank you.
Take care.
Cheers. See you
Take care.
soon.
Thanks, guys.
Bye.
Cheers. Bye. Bye.